Good morning. Thank you very much. It's always a pleasure to be here at the Minsky conference, and I've written some notes, but I will summarize them. So there will be a written speech, but I will summarize a little bit the ideas here and share that with you. The first point I would like to make is that it is now very clear that a number of euro area countries went through a Minsky financial cycle. I think it's interesting for you. I will focus most of the presentation, and especially the written notes will be on this. I say a number of countries. You couldn't say that for all the countries, but for a number of countries. So I think it's an interesting topic, actually, and an important topic. So before I do that, I will say a few words on the economic conditions in the euro area, and takes me something 5-10 minutes. First, on the activity, economic activities. Actually, we had very few surprises in our projections since a relatively long period of time. So we could say that our projections have been quite robust over the time. And I talk here about something like December 12, where we haven't changed very much our projections on real economic activity. We saw the recovery of the cycle in the second half of last year, and this has been confirmed now. So we have what we call a modest, uneven recovery. Modest, uneven, because it depends also of countries, where Germany is growing very strongly, and some others are still struggling to get out of, this crisis environment. But I think what is interesting also in recent data is that this recovery is increasingly broad-based. And I know the panel after will pick up some of the points I make here. But from what we see for the euro area as a whole, but also in a number of countries, that we see a pickup of domestic demand, which was already clear in the third quarter of last year, the fourth quarter, and we see continuing evidence on this. We start to see pickup of investment, excluding construction. We also see more classical inventory cycle. For example, in the third quarter of last year, we saw a building up of stocks, inventories. So always the question, is it voluntary, involuntary? Now we see that it was followed in the last quarter by demand, really. So the stock building was a sort of normal inventory cycle. Also on the positive side, because there is another side, but on the positive side, when you look at survey indicator, they have rebounded very strongly, reflecting in particular a very sharp decrease of uncertainty in general. Uncertainty in general fell very much. And this is especially true when you look at confidence indicator, business and consumer confidence indicators in stressed countries. Now there is some gap, admittedly, between the hard data, especially in these countries, and confidence indicators. So there is a contrast where the confidence have picked up much more than activity, real activity. So this is to be monitored in the future. But in any case, it's a good sign. So that's one of the things. The second is that this being said, there is the degree of slack in the economy is very high. It's very difficult to measure the output gap, but whatever the measure you take of output gap, we know this is a difficult discussion, but whatever measure you take, this output gap is unlikely to be closed before 2017 for the euro as a whole. So it may be, you may have within that different and contrasting situations. So that's on the real economy, the activity. So it's broadly in line with what we think since some time, but with survey indicators be probably a bit stronger, but these are soft indicators. And the degree of slack is very deep, is very high. Now, where did the surprises come? Well, the surprises have come from the side of prices, as you know. Inflation, the inflation outlook was in general weaker than what we had expected, This is not only the case in the euro area in general, but this is a phenomenon that you have found in a number of other economies. US also, you had probably this discussion also yesterday. So we had on the surprises side, it was a weaker evolution of inflation than what in general we had expected. But on the other hand, in terms of prices, you had another surprise on the other side, which is that asset prices have recovered very strongly, actually, since the summer of 2012, reflecting a number of things. But that recovery of asset prices, and you see that recently also, have been quite strong. I wouldn't say this is a surprise. To my sense, it was much stronger than what I had expected. So you have this contrast between weak consumer price evolution, selling price expectations of firms, producer prices on one hand, flows, and the prices on stock, asset prices being much stronger. Now, on asset prices, it reflects a number of factors. One is lower uncertainty. It's quietly related. Of course, if you look pre-July 12 and post-July 12, this whatever it takes of Mario in his speech in London, there's a big change in all the measures we can have of uncertainty. So that's one factor. The second factor is indeed better fundamentals. Can argue, but fundamentals look much better. And the third one is the risk channel. It's basically accommodative monetary policy. And that's what we call the risk channel. It's one of the transmission mechanisms of monetary policy is the risk channel. So that seems to work. And we see asset prices have picked up very much. And we usually say in our communication that, with time, it will feed through to the economy, higher asset prices, in terms of economic behavior. For example, if you look at investment, the Tobin skew, is much better than what it was before July, for example. I mean, many of these things, Now, if you look at another element of our monetary policy strategy, which is money and credit, what you see is that money and credit aggregates remain very weak, and we signal that in our communication. And credit is contracting. Credit to the non-financial corporations is still contracting. And the last 2 months have not been very good. The last 2 months, January and February, the data available on credit to non-financial corporations. But at the same time, and this is also something it's still difficult to assess, at the same time, this weak credit, so it's bank loans actually, is in very sharp contrast with capital markets activities, where the issuance of bonds and the prices of bonds, high yield bonds, but also normal, higher graded senior bonds, has been very strong. Issuance have been strong. So the picture is a bit contrasted, where there is a phenomenon of some disintermediation which is going on for the corporations, for corporates overall, in a weak environment, of course, where the demand for funding is relatively low, of course, because there is not much investment going on. But you have some substitution. So it's still, to some extent, difficulties in interpreting the figures because there is some substitution in favor of capital markets. But what is clear is that those corporations not having access to capital markets, of course, have a hard way, because there are a number of rationing mechanisms in the banking sector, and this especially for SMEs, but also SM, the medium-sized firms. And the second is that what we see in the transmission mechanism of monetary policy is that on the liability side of banks, things are going much better, also in terms of fragmentation. So the differences across the countries in terms of funding costs have been gone to an important extent. But on the asset side, when you look at the lending rates to the firms, they have not gone down at the same level. So the margins in a number of banks have been increasing. So the firms obviously try to restore intermediation margin. And so that we have some of issue about the transmission of our monetary impulse to the lending rates in the economy. So on the deposit side, you see the impact on the funding costs of the bank. On the lending rate, it remains something, a point of attention. Now, it is in this context that the Governing Council has, as we say, reiterated its forward guidance. The forward guidance came in July 13. So it's basically, we communicated the assessment I tell you now, and we say still now, our assessment of the economic situation is quite robust. We haven't changed our assessment. And so we did it in July 13, and you remember that July 12 was the very strong signal about the whatever it takes, you know, in the frame of our mandate and all that. You remember that. So there are two important milestones, what to stop the sort of panic pricing that we saw in July 12 and in 13. It was to clarify a reaction function. The environment is weak, as I described here, with subdued price pressure extending into the medium term. And we would have affirmed a sort of qualitative guidance in the framework of our monetary strategy, our two-pillar strategy. That's what we did, and we feel very comfortable with the forward guidance we give. We had, believe it or not, we have very good results with the guidance. Basically, July 13 was important because it was in the period of the first discussion May-June in the US about the tapering, which led to sharp increases of long-term rates, spreading a little bit into the world. And if you look at rates in Europe compared to the United States, in particular German rates, the Bund rates, and the T-bonds in the US, you will see a decoupling also, which starts at about that period. We also have seen that the reaction of our money market rates, so what we call the forward curves, you know, up to 2-3 years, has been much more insulated than before to international shocks, international news. And we do that, for example, by looking at surprises. You know, when you think the US PMI is going to be this, the reality, I mean, the figure will be higher or lower. Then you look at the impact of money market rates, the forward curves, to surprises, you know, in any surprises, PMI surprises, and non-NS surprise. And we see that the reaction is much lower than it was before. So we are reaffirmed, we reiterated our forward guidance in this context, adding also in the last Governing Council meeting, and this was new, we had two sort of innovation in our communication. One was a reference to the degree of slack. One of the reasons is that financial markets, as you know, can react very strong to news, with tendencies very often to overshoot. So given the fact that the cycle was turning up, there was also a possibility that markets would overreact to more positive news. And by pushing, for example, the long-term rates higher. And here the forward guidance was also very, very useful. And we added in the forward guidance a reference to the degree of slack by saying, okay, things in terms of flows are going better, so the business cycle is turning upside, but at the same time, the degree of slack remains very important. So we also put that in our guidance. Doesn't need to put precise figures. As we say, the degree of slack is quite important, and so whatever the figure, I think it's an element we wanted to communicate. It's an element that we have to take into consideration. The other thing, the second innovation we did recently was, was last week, it seems so far away already. It was that the Governing Council was unanimous in its commitment to using also unconventional instruments within its mandate in order to cope effectively with the risks of a too prolonged period of low inflation, It is not the risk of deflation or the risk of inflation. It's a risk of a period of low inflation, a risk of low inflation. So this is acknowledging, the Governing Council acknowledging its attention to the risk posed by a period where the inflation would deviate for a prolonged period compared to its own definition of price stability, which is close to 2% in the medium term. So that was a signal which has been the object of a lot of comments. What do you mean with that? What is the unconventional tools? I will avoid talking here because it's not the purpose of a conference. But the signal, I think the signaling has been quite important. And that's what we wanted to give at this stage. I also note, before I go to my second part, I also wanted to take note of the fact and communicate that actually when you look at what we call inflation expectations, in all this period, since the crisis, they have remained quite well anchored, actually. Depends what you look. Certainly the medium-term inflation expectations. But for me, one of the most amazing things is that we had a number of shocks, in the environment which we had in the monetary union, and banking shock, for example, sovereign debt crisis. And we have seen it several times we have seen that market prices have shot up very, very strongly. what I mean with market price is, for example, the price of protection against deflation. Price of protection against deflation spiked several times in the crisis period, but not a little bit, but really spiked, which means that at some points, markets were not sure about reaction functions in general of authorities, but also the central bank. In a banking crisis, because these are new things, you don't know exactly how the central bank is going to react to that, how the institutional setting, which is weak, we know that, is going to react to sovereign crisis and banking crisis. And so we had episodes, we should not forget that, of risks of the anchoring of inflation expectation in the sense of deflation. And you can see that very nicely, if I can say, on market prices. And actions, not only of the central bank, but also of the central bank, led very quickly to a reduction of these deflationary fears as expressed by market prices in options, And so it is some evidence that we in crisis management could avoid much bigger risk, Now what you see on these sort of indicators indicate no concern in terms of pricing, and probably because the market expects the central banks to do whatever it takes in their normal mandates. No, it's not a crisis environment, it's a normal mandate. Markets trust that the central bank are going to do what is necessary. And this is one of the issues that people talk. When inflation remains at a level for a long period of time, don't you have a risk of de-anchoring inflation expectations? And that's also why we signal very strongly the sentence which I reread now. So that's my first point. So now we'll go a little bit more in very fundamental problems that we have in the euro area, and you will see it's of course very much linked to my first part. So looking backwards, we had two recessions in the euro area. Yes, you had one big recession, the V-shaped recession in 2009, which was a worldwide recession. So world economies were extremely synchronized with this big V-shaped, dip. But we had a second one, which was related to, what we call now the sovereign debt crisis. But it's not only that, which was a more prolonged, but more milder in a way, but more prolonged recession, a sort of U-shaped recession, from which we came out in the second half of 2013, this U-shaped recession, which surprised, of course, again, surprised policymakers and agents in general. And there was a strong decoupling from the rest of the world, also from advanced economies and emerging markets. And now there's a process recently of recoupling with advanced economies. So the cycle is resynchronizing, the European cycle is resynchronizing with the advanced economies. I say the advanced economies because on the emerging market side, it goes the other way. But on the advanced economy, you have a sort of resynchronization of the cycle. But it was a long period where we were desynchronized with a relatively mild but long recession. And when I say mild, of course, it came after the previous 2009 recession. So it came on a sort of economic system which was, of course, weakened by the previous recession, of course. And so a little bit getting out of all this. There is also very... in the euro area picture that I describe now, there are very, very, very different situations, very contrasted situations across the countries. Of course, everybody would think about Germany on one side and countries like Greece on the other side. But actually, when you look at that, and that's the difficulty when you try to write a speech which is more general, it's quite difficult when you do that because you see so many idiosyncratic aspects in the crisis where Italy is different from Spain. You would say Spain is typically a Minsky cycle. Italy, you wouldn't say that in Italy. We didn't see this credit boom and bust that you have seen on the other side. You have another problem there. So if you look at France, for example, you have a country with very good financial conditions today. You cannot say that France's economy is under the difficulties are related to the fact that the financial conditions are much too harsh, which you could say for other countries, of course, like Greece or like Portugal, countries like these. So it's quite a difficult situation because you have a number of idiosyncrasies there, and at the same time you have common factors in the euro area as a whole. Weak institutional settings, for example, in terms of how to handle crisis situation. Just crisis management, crisis preparation is a common element, for example, that we have to address. But you have a mix of idiosyncratic elements, country by country. It's a lot of diversity when we talk about stressed countries and non-stressed countries, about peripheral countries, non-peripheral countries. It's not so simple, or the north or the south. We know it's much more complicated than this. So I pick up basically in the rest of my speech a cluster of countries, and I think it's quite important for the future to focus on these countries. And these are what we used to call the catching up economies, including Greece, including Portugal, including Spain, of course. And so the catching up economies, that means that countries which at the start, when they joined the monetary union, had lower GDP per capita. So when the economic and monetary union was put in place, there were high expectations in terms of standard of living for countries with lower GDP per capita. The idea was that real convergence would happen, so that these countries would grow faster than the other countries, than the average. And that was considered very important for the stability of the monetary union, because, as you know, the European monetary union is not a political union, so you don't have these income equalization mechanism, redistribution mechanism via fiscal policy. You don't have that. So a lot of trust was put in mechanism that would push real convergence, so that the weaker economy would get stronger over the years, and avoiding the debate on fiscal transfers and, let's say, mutualization or income equalization mechanism, as I write. So what would be the mechanism there? Well, the mechanism of reduction of the real income gap that was expected was basically via a market mechanism. And the market mechanism would be very simple in neoclassical theory, as you know, is that weaker countries, poorer countries in terms of GDP per capita, would have a marginal rate of return on capital higher than the countries having already a lot of capital, a lot of stock of capital from the beginning. So it was the question of the marginal productivity of capital would be higher in the countries with lower GDP per capita. So you open the borders, you have a framework which provides certainty about, let's say, monetary policy, which is an anchor for long-term investment decisions, and capital would flow from the countries with a lot of higher stock of capital to the countries with a lower stock of capital, let's say, or the high productivity countries to the low productivity countries, something like that. The classical neoclassical mechanism that would. The monetary union, the single currency in that aspect, as I say, was quite important because the single currency was also expected to accelerate the catching up process because the neoclassical applies whatever the exchange rate regime. But the currency was meant to be favorable factors in this catching up and closing the gap, the income gap between the poorer countries compared to the richer economies. And so for basically two reasons, the monetary union. And this is quite important. The first part is that economic agents, just in weaker economy, in poor economies, and policymakers would internalize the irreversibility of the euro. So you cannot be bailed out by the treaty. There is no bailout. There is no exit from that contract, from that union. There is no procedure to get out of the union. And so the irreversibility of the euro, once you're in, agents and policymakers of these countries would internalize that constraint and change their behavior. That means, for example, that wages would be more flexible because, if I deviate, it will be difficult to correct because I cannot have an external devaluation. And the same also for fiscal policy. There were mechanisms, of course, of control, which didn't work. But there were mechanisms of control. But normally, irrespective of these mechanisms, policymakers would also internalize that constraint in their fiscal policy and pursue policies of sound public finance. In case a shock would happen, they would be prepared for that exposed, but they would prepare ex ante for a future shock. So that was one of the mechanisms. So labor product markets would internalize that constraint, and that would accelerate the catch-up, of course, because you would have sort of structural reforms embedded in this contract, this monetary union contract. The second aspect of the catching up was the risk premia related to the pre-union low credibility of many of these central banks of the catching up economies. So many of these countries had devaluations of their currency very often. They were not revaluation, but devaluation usually. So at the end of the day, all these countries had high risk premium on capital markets. And with the monetary union, there was a way, when you enter that new environment with one central bank with a strict mandate, you had a credibility gain for these countries joining, which puts the risk premium very sharply down, and that would help, these economies to catch up, and so the risk premium would be much lower in these economies. So that was a little bit the reasoning, and to say, so it's essentially in monetary union without a political union that we have a high degree of cohesion in terms of GDP per capita, because if you have a monetary union where some countries do not converge, to the average or stay, on the verge, it will be politically difficult to sustain that union. So it was an element, this cohesion was an element which was important. And the other part of the argument say, no problem, if I can say, because there are mechanisms that would ensure that. And now, what happened, of course, indeed, what happened as predicted, and then what happened and was not predicted. What was predicted, indeed, is that we had, as we know, capital flows from the high-income countries to the lower-income countries, so classical phenomenon that we have seen also in a more international context. It's quite striking. When you look at that, we had the capital inflows in catching up economies were multiplied by 5 in very short period of time. So that was very important inflows of capital. And so this capital, so that one part. The second part that we saw is that, as I say, on the surface, you saw that the developments that we saw in the real economy appeared to contribute to convergence, to real convergence. So there was a sort of verdict to say, like, we have converged. Indeed, the model we have in mind seemed to work. We had real GDP growth in the catching up economy for a number of years, until 2008, basically, in a number of years, were higher than in the more advanced economies in general. Italy would be a kind of exception in that picture. But usually they had, these catching up economies had a real GDP growth which was higher. So there was also a strong accumulation of capital when you were seeing the figures, and not going behind the figures, but you were sort of, I call it now a sort of illusion of real convergence. Now, what really didn't appear in these years is that actually all these capital inflows in these countries did not, unfortunately, translate into faster total factor productivity. And it's very interesting to look, and it's documented in the paper I have here. You see a big contrast between real GDP growth and productivity, actually, in these countries. And so capital flows flew basically into sectors where the marginal productivity of capital was low. So the inverse of what we had expected before, and falling productivity also. So not the dynamic part. And basically, we know the story now very well. It's in the non-tradable sector, not only in construction sector, but also in other sectors. Transportation, for example, also. In the retail sector also. So in the non-tradable sector. So why is it so? Actually, that's the sort of paradox. You have this. And you had what we saw, no, we do extended study on that situation now. For example, you see that some of these sectors where the marginal productivity of capital was falling, just non-tradable sectors, some of the non-tradable, and then you compare that with the profit margins in that sector. So you say sectors with lower productivity, but the profit margins were going the other way. So you say capital would go in these sectors because they are profitable, even if they are less productive. So why is it so? Well, the paradox is basically has to do with competition, has to do with protected market, has to do with rents. So that's one explanation. The other explanation that you have of that also is the low borrowing cost, not only in real terms. In real terms, borrowing costs have fallen very sharply, and that has fed into a credit boom, as we know, because the sector is very sensitive to borrowing conditions, but also the nominal rates really collapsed, the nominal rates. As we know, the nominal rates are extremely important in the first year when you borrow money to buy a house. The nominal rates is quite important because it has a big impact on the cash constraints that you have, on your cash flow. Even if in real terms, in terms of net present value, you could say the real rate really it's what counts. But in terms of cash flow, the collapse of nominal rate was very important to reduce the cash flow constraints on the borrowers. And so we had indeed what we know, and certainly in sort of Minsky sort of framework, what you had is a classical credit boom in households and non-financial corporations. Looking backwards, in the 4 years before the crisis, the volume of credit in the household sectors in the catching up economies, largely Spain, but not only Spain, 23% per year, 4 years in a row, on average, on the 4-year periods preceding the crisis. If you take the non-financial corporations, you had 28% per year increase of credit in the non-financial corporations. So so that's the second factor. I mean, it's just the fact that financial conditions improved dramatically once these countries joined the monetary union, and that allowed also these countries to fund cheaply increasing but very important current account deficits in the range of 10 percentage points of GDP, sometimes much more than that. And so the funding, the funding constraints was, as we know in bubbles, is extremely loose. Current account deficits of more than 10% of GDP, as I say, could easily be financed, and that's another element in the picture, there was basically financed via wholesale markets, and within wholesale markets, largely the interbanking market, and short-term, as we know, in the interbanking market. So you have a network of reallocation of savings from the more advanced economies to the less advanced economies, but via the banking sector and via wholesale short-term markets. We know that, I know you're well aware of this. And then came, of course, the sudden stop. Why didn't we recognize it? And I think I'm doing that also looking a little bit backwards, also as a central bank, because in our two-pillar strategy, we also look at credit. And I look back, in all our communication of the central bank of these years in 2005, 2006, what were the signals we were given? And indeed, I recognize a lot of signals about excess liquidity, very booming credit markets, especially in some countries. So some of the signals have been given, even there have been marginal increase of interest. With hindsight, you say marginal, without an effect, of course, of that dynamic. So why is that so? And it's always the same story. This time is different. Always we have to go back to these situations and try to put us in the context of these years. Why didn't we see that? And where were the rationalization of things which were, obviously with hindsight excessive? And and I looked also in 2008, for example, what European Commission, but I could find maybe also, other institutions, but the European Commission wrote in 2008 that the cohesion countries, that means those catching up countries, that the cohesion countries have shown satisfactory developments overall. So it leads us to be very modest also in the future, because, and it's important to draw the lessons of that too. But at that time, in 2008, just when the crisis was really there, we had a sort of benign view about the situation and the catch-up. So again, why is this Minsky cycle that we failed to detect? And I looked at that also in terms of two things. One, and it's very important for the future. The one is that when an economy is booming, one tends to revise upwards the potential output, the sustainable output. And I refer to people you know very well in this environment. Here is the Claudio Borio and others from the BIS looking very much of this, what is the potential output, what is a sustainable business cycle when you take into account the financial cycle, what is a sustainable one. And I don't have it here because it would take too much time, but I looked, for example, at the estimates of the potential output as we saw it in these years in Spain, for example, and we said the potential part was continuously revised upwards because the bottom line, which we used in general as economists at that time, was to look at inflation and was to say, well, if this high rate of growth in these countries would not be sustainable, so that because resources would be stretched and all that, inflation should pick up actually, because that's the synthetic indicators of tensions between the supply and demand. And we didn't see that, so there were a lot of revisions upwards of the potential output. Now we do exactly the opposite. The economy goes down, plunges, and the potential output is continuously being reduced the other way. And so just to say that when we, in our communication, also talk about a high degree of slack, we are very well aware of the difficulties. We say the amount of slack is important. We don't know exactly how much, but it's an element of policy because it is there. It is there. But on the other hand, when people may ask you, what is it, 1%, 3%, whatever it is, you have to be careful and you have to think about the mistakes that unavoidable you are likely to do. So you have to have a more qualitative approach to this and a careful approach to this. So on the potential output, so I'd say usually the potential output is very pro-cyclical. When things go back, you revise upwards. When it's downwards, you revise the other way, your potential output. So there's an element of pro-cyclicality there. And it's also learned as you know, price stability is not enough to get the picture. When the sudden stop came, given, as I said, the short-term funding issue, there are basically four issues we are dealing with now, and I'm getting closer to the conclusion. We have four issues we deal with. We have, of course, as usually in all the Minsky cycles, you have the debt overhang problem, how you deal with that. Second is, in these countries, you have a number of problems of price competitiveness, what we call internal devaluation. These countries have to have a sort of internal devaluation because they cannot externally devalue, so they have to restore price competitiveness. The third is the productivity challenge, the total factor productivity thing I mentioned before. That these are the three first issues. The fourth issue has to do with euro area reform, because the first three are more national and depends on the circumstances of each country. The third one is more euro area reforms. And in the euro area reforms, one of the key aspects that we also as a central banker, I say that, and that's our policy. One of the key elements for the future is the banking union. It is not really to say, well, it's not just a fad, I don't know what, but we think it's key because we think in a monetary union, you need to develop real private sector risk-sharing mechanism, because here you had a sort of risk-sharing mechanism in good times where capital flows to another one, and when things go the other way, you go back to national borders, basically because the banks are national when the situations gets difficult, and are global, as you know, when things are good. So it's a typical situation that we know in global markets, but in a monetary union, of course, where a country doesn't have this option to devalue, it's quite important that the private sector risk-sharing mechanisms work absolutely fully. I don't say this is a sufficient conditions, but it's a very important conditions for a monetary union to work. Now, we are not yet there, so we are in this big project of banking union, and as you know, there's not only this sort of risk-sharing where, for example, ring fencing would disappear. In a truly banking union, the ring fencing behind the national borders would disappear. Of course, you also need backstops in that environment when the private risk-sharing mechanism at some point reaches its limit. But I mean, all the efforts that we have now have been very much concentrated on that aspect of putting in place better mechanisms of private sector risk-sharing via the banking union. And this is one of the big projects. I cannot really expand very much on that. It takes us a lot of time, but we really believe it's an essential thing. Now, if you look at the three others, and I'm close to the end now, when you look at the three other points, the debt overhang, country per country, I'm not going to say Greece, what is the situation in Greece per. My experience now, and we have been very much involved in these countries, a lot has been done already. We can discuss case by case, of course. I know much better Spain, for example, than some other countries, or Ireland. I know relatively well also the situation. I know the Greek situation remains also a difficult situation. But when you see the changes which have happened, they are quite spectacular also there. You may say it's still a long way to do, but it's quite spectacular. We have been quite satisfied by when Spain, I remember Spain asked for financial assistance at the European level. It was very rapidly a very big change in the way the debt overhang was approached. They were also induced also by this framework of financial assistance, European financial assistance, important changes in domestic institutions, like, for example, solvency procedures, bail-in procedures, for example, also there. So I think that this mechanism has been quite improved. On the price competitiveness story, the internal devaluation, a lot of the competitiveness handicap have been closed. And in the context of this low inflation environment, there is a lot of questions about the fact that if countries have to continue to recover competitiveness gap, they may need to have negative inflation. You know this debate. I would say here that looking a little bit at past history and considering also what has been already achieved in terms of price competitiveness in these countries, I think that the main element has largely disappeared. Disappeared is a bit strong to say, but this is probably not anymore the essential element in terms of price competition. The essential elements are the other elements which have to do with productivity, structural reforms of the institutions, and things like this. And we see that very much in some countries. For example, I can tell you an example that we discuss. If you take a number of countries, weaker countries, which could devalue pre-monetary union, so they had the exchange rate, and they used that exchange rate instruments when they had competitive handicap. I said before, they would at some point pay the price because of, via high risk premia. Okay, fine, that's one thing. But the other thing that we see in the experience of external devaluation is that the countries using the most the exchange rate instruments usually, again, you have to look at specificity, but usually did not really progress in terms of reform or productivity, you see. So the instruments, the exchange rate instrument can be very useful, of course, because you can restore a price level, you can change suddenly your price level compared to another. But beyond that, you see also very quickly that it's not really the most conducive instruments to go into reform. And so the experience of exchange rate historically is not that good in terms of enhancing productivity level. It just restores a little bit a price competitiveness, but very quickly you lose it again. So this is for the three. So you have the debt overhang, how you tackle with that. And as you know, we have this comprehensive assessment exercise, which not only for the catching up countries I mentioned, price competitiveness and internal devaluation, I say a lot has already been done. And I think the focus now is more on the productivity challenge. And there what we are doing now in countries, as the countries themselves are doing, is try to, because structural reforms take a lot of time, so we don't have that much time, is to try in countries, and that's what some countries are really trying to do, to identify the reforms which have the most impact in the short run. And I can give you, if you look in Italy, for example, you would probably say that the reform of the judicial system is one of key importance, as recognized by the government, for example. If you look, just an example, if you look, for example, the Italian banks, and you look at, you have non-performing loans as all the banks, but if you look at the degree of coverage by collateral of these non-performing loans, in general, on average, in Italy, it's higher than in a number of other countries. That's the good news. The bad news is usually that the capacity of a bank to seize and liquidate this collateral is more difficult in this country than another country. takes much more time. So how do you weigh the two? So there are ways, and that's the OECD has been, I think, good in trying to identify with countries also which are the specific measures which should be prioritized to get the maximum leverage. I'm not saying that everything is good in practices, but it's a little bit the direction in which we try to go. And so I will stop here by saying that well, I think I finished here. So this private risk sharing, that was our biggest chantier now, our biggest task now is to try to put that in place and complete this, what we call the comprehensive assessment by the end of this year. The good news, if I can say, is that it has acted as we hoped, as a sort of catalyst in the sector to front-load some of the recap measures. And this is something which is starting to happen in the banking sector, as identified also by capital market analysts in general. So this is the story. Thank you. Yes, I have to leave at 10 because I have an appointment, but I'm very happy to listen to some of the comments or questions. Are not really, but interested by reactions or comments, and I'll see if I answer. But I'm quite curious about it. Yeah. You do. Yeah.
Gentleman here.
It's interesting to me that you view potential growth estimates as very pro-cyclical. And I'm wondering what that means for policy with respect to real interest rates in particular. Yeah. Should you then, not just you, but monetary policymakers in general, does that reinforce stability? You shouldn't be moving things around with estimates of potential growth because it really is ephemeral.
Yeah. We don't have time, but it's an important question. Usually, I mean, now in the debate on inflation, you say inflation and output gap, sort of Phillips curve debate. For those interested, you look at the WEO, I mean the WEO of the IMF, World Economic Law, of last year, exactly last year, and where they look at all these Phillips curves, in different periods of time, and look at inflation expectations plus the output gap, basically. And then they run different regressions. And they say the sensitivity of inflation to the output gap is falling, so the Phillips curves gets flatter and flatter and flatter. And they say the only element that explains that's what they wrote last year, the only element is the anchoring of inflation expectations. So you can have output gaps, revisions of output gap, and always no impact on inflation, basically, because inflation expectations are solidly anchored. And so you're much more stable compared to variations or mistakes in the output gap. And then they say the only element that we can find is the credibility of central banks because they had inflation targeting and all these things. So that was a little bit the reasoning. Now we have to think about this because when the output gap obviously becomes big, it can have an influence. So is the Phillips curve getting steeper at some occasion? What do you get, of course, if inflation expectations become more de-anchored? So the debate now is restarting a little bit about that. But look at last year. Now the debate this year in the fund will be more low inflation environment. What are the risks of de-anchoring? And what is the role of the output gap? Does it strike back or not back and all that? We are not so much in terms of precise the figures. With what stress, as you saw, I mean, the more cyclical aspect, I think that's an element of warning, not necessarily linked to inflation, of course, but it's an element of warning about these estimates. So I don't know. I mean, but I know for Spain, we had this sort of comfort. The higher the growth, we don't see inflation, so we conclude output gap, they can grow at 4% without problems. And that's, I go back in my mind, I go back in the Borrios, the BIS sort of thing to say, well, price stability is not enough. We also have to look at, which is a Minsky inspiration, we have to look at sustainability of the cycle. And I mean, this typical story, I mean, textbook case, but in the framework of a monetary union, which made it a bit worse, I could say.
In the front here. Please wait for the mic.
Hiya. Yes, yeah, hiya.
So I was You pointed out really what I think is one of the signal features of the landscape at the moment, which is that on the bank liability side, you've had this extraordinary compression. But on the bank asset side, the real economy lending rates, you still have very dispersed interest rates. That, on the face of it, suggests that there's a meaningful capital shortfall in the banks, although there may be other explanations consistent with that. Are you confident that the process of the banking union transition itself, absent further policy interventions such as purchases of assets by the ECB, will be sufficient to essentially trigger the second round of reduction in fragmentation, being on the lending rate side?
Well, you don't go to I see where you want me to go, but no, but it is true that we are looking very much on the impact of this exercise on lending, and it's quite interesting because the picture is not so black and white. I mean, we look, for example, in Spain with the Bank of Spain, if access to finance of medium-sized firms in the export sector. In the written speech, you will see it's quite interesting in Spain when I talk about internal devaluation. I'm sorry, it's not really a diversion, but it's quite important. I forgot to mention that, is that in Spain, for example, the loss of competitiveness that you see on aggregated figure, when you look at the traded sector in Spain, they have been quite good, actually, in all the periods. They have not lost competitiveness, which was really, the wages grew much faster in the protected sector, actually. In construction, obviously, in these years. And so looking at that, we think also the sector is well placed. I mean, they gain market share, as you know, and the export is quite vibrant from a low base, of course. And so we are looking, and what is the access of credit? What sort of constraint is it in the reallocation, you know, of resources from, let's say, construction and other sectors to the more traded sector and all that? And so we are looking at that. So far, we don't really see that, but it's true that it's not really banking credit that will only make it, you see. It's the other forms, venture capital and other things that also have to be developed. Now, so we look at that. So I just wanted to put your question, not only because I know where you want to push us as central bankers. Usually a central bank is to be much more active in bringing things that could lead to a better credit allocation, a better credit. So I think it's a broader picture than that, and we don't want to come also with, you know, measures without having very well understood, you know, what is the real problem before you act, if you do. Now, we have noticed in Spain, for example, very recently, just to go a little bit more focused on your question, if you go at Spain, for example, it's relatively new. You start seeing banks prioritize, because banks, they have their legacy, but the legacy, I think we have taken a lot good in control, and the process of adjustment is well taken. You know, as you know, with Sareb, you know this process, and the banks are starting to refocus. There is increasing competition on the lending markets with banks wishing to, you know, increase their market shares because, you know, how are they going to do in 10 years? So they seize also the occasion to gain market share. So we think the competition conditions are improving on the lending markets in SMEs, but it's still a bit early to tell. There is room also for government, because it's easy always, central banks should do this, they should do that. National authorities, it's not that difficult in terms of amounts of money. I'm not saying in practice for credit allocation decisions, but in terms of amounts of money, these amounts of money are usually not that high to stimulate credit. The problem is more how you go into the origination process, but in terms of money involved, it's not that big. So all in all, I mean, no, the main question that you have is this prolonged period of low inflation, which is a more generalized phenomenon, which also we question how do you link that with the output gap, with the degree of slack, given also the experience I mentioned in the previous decades. Because if you look backwards a little bit, in the year 2000, at the boom of the cycle, you remember we had a period of low inflation already, and we had booming asset prices. And you had a little bit this constellation in a different environment now, because you have weak inflation, asset price, but in an environment of slack, which was not the environment of these years. And so these are still things that are quite important to understand. I mean, you have seen the debate in the US also in the minutes, for example, of yesterday. Yes, yes. I will have to rush because I have an appointment.
Yeah, this is the last question.
Just to listen to your questions.
Mr. Praet.
Yeah, what she was. Yeah, no. Well,
no, go ahead.
Thank you very much for your presentation.
But you get it.
I was surprised to hear your assessment about the past, where you pretty clearly said that the ECB was operating on the wrong model. That the theory was just turned out to be wrong when you
not
talked
the ECB, not the ECB.
No, everyone, the Commission as well,
yeah,
of course, not just the ECB.
Well, the world.
When you held those,
the world. Think about it.
That too, yes.
Yeah.
So as to the past, you are saying that you were operating on the wrong model. A number of times you paid lip service to Minsky, so perhaps Minsky is the right model. So, but when you start talking about the current situation, your assessment of the current situation or what needs to be done for the future to get out of the situation, you seem to be back to the old model. What really has changed, I'm wondering? I mean, you advise you refer to productivity growth and structural reform. I mean, look at what the situation in investment is, public investment, private investment, completely crushed. What do you expect about productivity growth in that kind of situation? So that's the outcome of the policies that were chosen in this crisis. And where is the change? I don't see any change. You could just continue what you've done in the past.
Well, don't take it personally. No, I think there are different things. I mean, one I think is the crisis resolution, which is a key aspect on any market economy which was, not in place. I think this crisis, not only management, the crisis resolution, how do you deal with creditor debtor problems where you have misallocation of capital, which for me was one of the biggest weaknesses in the previous period. So that's one example. So that's why when I come with my banking union and I want to, how do we say that, elaborate, we have to spell out, the conditions of when creditor-debtors relation gets sore, they get bad, how you deal with that. And we didn't have that. That's a major change, I think, in the environment. There are others, let me just think a little bit, but I would say that would be one of the things I would come with to beginning with. I think really, we have to I think well, you have a small sarcastic smile that the other of the audience do not see, but I went through. Look at him. But I can tell you really that in a market economy, when things go bad, and people can rush, and the credit debtors nobody, and then the taxpayers come in, I think that's a basically weakness. So when you say we had a model, we go back to the same model. What we are trying to do is to change that. That's one of the aspects. Others, of course, but no, please, don't want to go in a long debate with you, but
I'm afraid that's all we have time for.
That's what I say. But we deal with debt overhang.
We have to move on to the next.